So to this point, we've talked about what happens when stock options are vesting, how we want to account for that compensation expense. And we match the compensation expense to the service period. Once all of the options with a particular exercise are fully vested, then there would be, all the options from a particular grant are fully vested, then there's no more need to match allocation expense for the period. So now let's talk about what happens further down the line when the stock options are actually exercised. So the first question is, of course, where do the shares come from? Are they shares from the treasury stock or are they newly issued common stock? And for the purposes of our bookkeeping, we'll assume that these are an actual new issue of common stock. So the journalization of the option procedure, of the option exercise, is pretty similar to a stock issue. So let's look at it from that point of view. Now, if 40% of the options are exercised, that means that we have 400 options in our example being exercised because there were 1,000 altogether. And each of them had an exercise price of $40 per share. And that's just going with the information and the problems we've already done. And remember, the fair value was also $42. So those are some items that will inform the accounting that we're going to perform when we exercise these options. So then we just take the 400 shares and multiply it by the various measures. We do receive cash because remember, when our employees exercise their option, they're having to exercise in at $40 per share. So the share will be equal to, or the amount of cash received will be equal to the exercise price times the number of shares that have been exercised in this exercise. So that's $16,000. Now also, because we have exercised the option, we no longer have a need to have this sort of placeholder APIC in play. So the APIC stock options that we recorded during the recognition of compensation expense are now also going to be reduced. Now these were recorded at the fair value of the shares because they were perfectly correlated dollar for dollar with compensation expense. And so we just have to reduce them by what we put them in for, which was the fair value, since that's how we record the compensation expense of shares. And that's how we record also APIC stock options. And so that comes in for $16,800. Now we just treat the rest of this like a new issue where we have common stock, and the common stock would be at the par value. $4,000. And then APIC is the plug as usual. APIC common stock would be $28,800. And so that's how you would journalize the issue of a share. Remember, it's a cash account. You reduce the amount of equity that those stock options that have been exercised contributed, and then reclassify the equity as common stock and APIC capital stock. So it removes the APIC stock options from the books, and it transfers that balance, that does, but also when an option expires. So if we do not take advantage of the exercise, and our options expire, then we need to remove the APIC stock options from the books in a different way. In the exercise, we removed it and then added the new issue. So if we just do not issue our stock and it expires, then we're going to move the stock option APIC into APIC expired options, which is just another related account. So if the remaining 600 expire, then we have 600 options expiring. And that's just the 1,000 grant, and then the 400 that we exercised 40%, so 60% was left unexercised, and then we said assume that those expire. So the 600 that expire times the price at which we put them into APIC stock options, the $42 fair value, is going to give me the amount that I would transfer from my APIC stock options over to my APIC expired options, which is $25,200. So we debit APIC stock options and credit APIC expired options. And then this would just remain with the firm in perpetuity as contributed capital. The idea is that essentially our employees earned a right to their salary and essentially didn't claim their paycheck. And so it's their service or their non-execution of that right is just a contributed capital piece to the firm, but is carried in a different account than APIC stock options. So now sometimes we will have an estimate of forfeiture in terms of employees leaving the firm, employees being fired from the firm. And if we have previous experience with forfeiture, then we can discount the amount of options we do not believe will be vested or used because of termination, because of employee turnover. Or if we don't have any experience with this, then we will just handle it on an as-needed basis. So it rolls in line with a lot of our estimation procedures that if we have a formal estimate, then we want to use that in order to project what will happen. But if we don't have an estimate, then we just have to wait until a confirming event occurs. So with the no previous experience, you kind of treat it like a direct write-off, just write them off as folks leave or are fired. With the prior experience, then you can, again, adjust in at the initial grant date and just say you had a 5% experience where 5% terminate before they're vested. Then we would just write 95% of those options in our journal entry. So returning again to the first example, we say we had cliff vesting and we had that $8,400 in compensation expense for each year that the 1,000 options were vesting, and they had an option price of $42. So let's say that employees covered by 10% of the option grant left the firm at the end of year 2. So this is the first time the company has encountered this. Then what is the journal entry we would need? So remember, if we are doing that first cliff vesting example, we're doing $8,400 a year in compensation expense. And so if we're at the end of year two, we've already recorded $16,800 of compensation expense and also relatedly APIC stock options. And so if 10% is going to be reversed at that point, then we would just need to make the entry to do that. We would need to debit APIC stock options by $16,80 and credit APIC expired options for that same amount. After that entry, we would have reduced our APIC SO to the appropriate amount. And so now my APIC SO account correctly reflects the fact that I don't have the amount of options I had before. I reduced it by 1,680, which left me with 15,120. And that perfectly reflects the fact that I have now 900 shares remaining in this, multiplied by the fair value of $42 each. And so just writing that off directly works. If we knew that we had 10% and we had that as a historical estimate going forward, then the idea is after we calculated our total compensation expense of $42,000 as we do initially. And remember, the total compensation expense is just the 1,000 options multiplied by their fair value, $42 each. And so that gives me the total compensation expense associated with that grant. Then I just want to multiply it by 90% in order to determine how much of that is actually going to be vested as a rolling percent of what we've had terminate in the past. And that would give me $13,800 of expense to recognize each year. Or total, I'm sorry, in total, and then divided by the vesting period, which is 5 years. And that gives me $7,560 of compensation expense per year. So then the entry with that logic would have just been logged in this way. Because we had the experience, we wouldn't have the 8,400. Rather, we would just reduce our total compensation expense and therefore reduce the amount that we recognize each year with the prior experience. And of course, now if you look at it, if we log this for 2 years, it would come directly to that amount because we are just accounting for 900 shares. I want you guys to take a look at Brenna's crack crock. It's a case where you have an accelerated method of recognizing these items. Remember that under IFRS, the grading schedule, if you have a graded vesting period, you have to use the accelerated method. If we are doing US GAAP, then we can do the straight line or the accelerated method of accounting for graded vests. But this is a graded vest because it comes due in 2 tranches. So give that one a work. It'll help you out. We'll look at it in class first thing. The next thing I want to talk about is the tax consequences of a stock-based compensation plan. And so there are 2 types of plans with reference to tax benefits of having a stock option plan. There's an incentive stock option plan and a non-qualified plan. The non-qualified plans are the actual tax incentive plans, even though they don't sound perhaps like they are. So in this one, the firm gets a tax break. In the other one, the tax does not. The firm does not. And so we'll look at each of them. Under the incentive stock option plan or an ISO plan, the employee doesn't pay a tax until the shares that are acquired from the option exercise are subsequently sold. So in this case, GAAP capital gains for the employee don't accrue until the employee actually sells them. So for example, in this case, then the employee is getting an intrinsic value. It's whatever they exercise at and the market price, right? So the market price minus the exercise is equal to the value to the employee. But what we're saying here is that that value isn't taxed in an incentive stock option plan. So even though it does have value to the employee, the capital gains are deferred until the employee exercises their option, takes a hold of the stock, and then sells the stock afterward. The company doesn't get any tax deduction for compensation expense. The compensation that the firm then records is going to be a permanent difference and hence have no impact on the deferred tax situation. So this is an example of a type of permanent difference if the plan is not an incentive stock option plan. If the plan is a non-qualified plan, then the employee pays tax at the time that the options are exercised. So in this case, the employee is taxed on the intrinsic value. And the company is going to get a tax deduction that equals that spread, the market price and the exercise price of the options at that grant date. So the employee's tax payment is the employer's tax deduction. So then when we book compensation expense for the service period, it actually creates a deferred tax asset because it's going to actually result in a tax deduction in the future when they get a write-off on the intrinsic value of the exercise. So it creates a DTA, a future tax benefit. Why does it create a future tax benefit? Because we're recognizing compensation expense today, but not something in my taxes. So what that does then is it makes my taxable income greater than my book income, which in the future then my taxable income is going to be less than my book income when I get the deduction from exercise. All right, so let's take a look. How would we record that? It would be, of course, with the compensation expense, because as soon as we record the compensation expense that accrues an APIC SO for whatever amount, we are going to also then record a DTA for whatever amount that compensation expense was times the tax rate. And so while we have the compensation expense reducing net income, we have a second entry with a non-qualified plan that actually reduces some of that expense and increases net income. And so we have a two-piece effect here. Of course, you'll still lose money because we have to consider that when we have a DTA, we're spending $1 today to save 40 cents on our taxes in the future, right? So it's not necessarily desirable by itself, but because it also tends to other ends, other results, it's not an altogether bad thing to have an abatement of our tax expense when we're recognizing compensation expense. So at the exercise date, then, the firm removes the DTA, reduces current taxes payable, and that tax deduction, the debit to current taxes payable, is going to be the tax deduction that is associated with the option exercise. And as I said, it equals the spread between the market and the exercise price, which is just the implicit value at the time of exercise. And then that would be multiplied by the number of options, which would in turn be multiplied by the tax rate, because we're dealing with a reduction in taxes payable. So we're talking about an amount that has been adjusted then for taxes as well. So what we have then would be something along the lines of cash, APIC SO. We would have CS, APIC CS. We've already seen that in action. Remember, the cash comes at the exercise price. APIC SO is going to come at the fair value. CS is at par value, and APIC CS is a plug. And all of those three items are multiplied by the number of options exercised. Now, the next one, like I said before, once we have the DTA, we want to reverse it. And the reversal of the DTA we'll also see some taxes payable reduction. The tax payable reduction is equal to the market price less the exercise price. Again, multiplied by the tax rate. Now, the DTA was created off of compensation expense. Compensation expense was created off the fair value of shares. This would be multiplied by the number of shares exercised. But when we're reversing the DTA, we want to get rid of it at the rate at which we put it in. So we put the DTA in with a fair value times the number of options. We're going to take it out at the fair value times the tax rate times the number of options. Okay, so that's going to be the basic skeleton entry of a non-qualified tax plan. If we need an additional credit, because now the point is that we put it in as a DTA, which was the fair value times the tax rate. The market minus the exercise times the tax rate is not going to equal that unless the market minus the exercise equals the fair value. So unless this is equal to the fair value, we're going to need an extra debit or credit. So if we need an extra credit, we are going to use APIC, tax effect from stock options, another APIC account. We would debit taxes payable, credit the DTA, and then credit APIC tax effect for any amount we need to balance the debit to taxes payable and the credit to the DTA. If an additional debit is needed, then it's very similar to like a reissue, a retirement. We want to debit APIC tax effect until there is no balance left. Once there is no balance left, then we want to debit not retained earnings this time because it's tax related, but tax expense. And so if you have more DTA being reduced than your taxes payable, you need extra debits. Extra debits first come from APIC tax effect. They then come from a debit to tax expense once that is zeroed out. So you have now two plugs, potentially. Right. The final case, again, is something that I want you to try out. You should certainly be able to do up to the exercise. And I want you guys to do the exercise, and then you should also be able to do the final piece. But go ahead and work on those two cases. I will quickly cover them in class, and then we will work more problems in class that fall at the end of these notes. Thank you.